Today's hot sheet, I'm discussing 10 markets to watch for rate unlocks, CoreLogic Home Price Insights, and Zillow's latest forecast, as well as mortgage applications. Today is Wednesday, August 21st, 2024. I am Byron Lazine, and the hot sheet starts now. Okay, here we go on a really packed hot sheet here as we kick off this Wednesday morning. Let me know which market you're tuning in from if you're here on the live stream. If you get value from the hot sheet, goes live every single Monday through Thursday, the only live housing show that exists on the internet. Go ahead and hit that thumbs up. It's how more people can reach this video, as well as the @NowBam YouTube channel. If you're getting daily value from this, go ahead and consider hitting subscribe down below as well. Okay, quite a bit going on here, and it's a pretty busy day in the economy as it relates to housing in general. The FOMC meeting minutes are going to come out later today at 2 o'clock. We'll break those down tomorrow. We'll pick through it and identify everything that you should know that was mentioned in relation to housing. We'll pick it all out of those minutes. Those are usually lengthy reports, but we'll do the work. We'll go ahead and do that. Also, when we do that, we put together, as we do today and every single day, our hot sheet notes, our daily notes that end up inside of BAMX. Here's just what today's look like. You get this information curated with the links to the sources, as well as all of the charts and graphs used inside of BAMX every single day. BAMX members have access to that, are using this as a copy and paste template to use inside of their database communications and marketing. You can get into BAMX and get access to all of this by using code HOT. All right, so we're going to get that later today at 2, the FOMC meeting minutes. That's going to be, significant news. Obviously, 2 days before Jerome Powell's talk in Jackson Hole, which comes this Friday. The bigger news today, though, is what I alluded to on that Zero Hedge X post on Monday. The one where they said there might be a revision downward of 1 million jobs over the last year, that we might have exaggerated how good this economy and this job market is. I'm going to address that. There's a whole bunch of reports. We're not going to know the actual data until 10 a.m. This morning. I believe it'll come out at 10 a.m. if it comes out on time from the Bureau of Labor Statistics. There's a lot of reports that are validating what Zero Hedge said. I'm going to save that until the end. We'll get into it. If true, I would expect the 10-year to move down later today, and we get one of those 30-year fixed, maybe back down to 6.25, which we saw just now a couple of weeks ago. We've been hovering around that 6.5 range. Now, I've been very all year last year saying if you're rooting for fast, quick reduction of rates, you're rooting for a lot of people to lose their job. This is that we've over exaggerated job growth. Okay. New jobs. Not we, but the market has, the analysts have. All of the revisions that come out, headline data on economy, strong. Then you look rear view mirror backwards. Those revisions have been less than good. They've all gone down over the last 6 months, but people see the headline and they don't typically always see the revision. We're going to pay attention to this revision here. Okay. First, let's get into the 10 markets to watch for. Watch for rate unlocks. This is a report according to realtor.com. Just put this out. Okay. So these are the markets, 10 places where lower mortgage rates will unlock the housing market the fastest. Okay. So for several years, high mortgage rates have obviously kind of froze up. I called it the Cold War. A lot of people called it, the lock-in effect of, hey, I've got this low rate. I don't want to sell, et cetera. I might want to move, but I don't want to give up this low rate. Okay. We've all seen that. We've all felt it. Now, as rates are starting to trend downward, 6.5, we've seen 6.25. There's some analysis that shows we could get as low as 6 by the end of the year. Anything better than that would be amazing. Now that we've seen that, there are metro areas that are starting to show the early signs of thawing out of this lock-in effect. Those markets are the ones with the highest share of sales when rates averaged 6.5% or more. Okay. The markets where you're going to see the most inventory is actually the markets where you're seeing rates above 6.5%. Those homeowners are unlocked now that rates are at 6.5. If you're at 7.5, hey, you're unlocked. You're in a position, one, to obviously refi. If you have a rate near 8%, which some people do, and rates are now at 6.5, you're in the zone of refinancing. Talk to your lending professional, obviously. But you're in that range. Depending on the person, they may suggest 1.5% difference. That's kind of like the minimum that they're looking for on average. You're starting to get in that range for refinances. You're also in that range of like, this isn't the right house, this isn't the right location. Let's go ahead and move this. I'm totally comfortable going and buying another house because I'm not trading from a low rate to a high rate. I'm just flipping. Maybe I'm actually making up a percent there on the range. Okay, leading the entire list is the location that I'm sitting in right now. Leading this list is Naples, Florida. 15.2% of mortgages are estimated to be above the 6.5% cutoff, compared with the national average of just 5.3% of mortgages. Okay, so if you're in Naples, Florida, like I happen to be sitting here right now, and you're an agent, I'd be using, Bobby, if you can link up PropStream, because PropStream will give you this type of data. We actually have a BAM code. I don't know if you can put the BAM code in there for people who want to get access to the information, but I'd use something like PropStream. I'd find everybody that's over 6%, and I'd be having multiple discussions with those homeowners every single day. That would be on my list. Okay. This is a market where you can do that. And the results that are around me everywhere in this market are supporting this thawing out that Realtor.com is talking about. It is absolutely nothing but the truth. Inventory is mounting up. It's going up at a really fast pace. So you have this combination of people that are over 6.5%, the leading number in the country, 15.2%. There's also a lot of cash buyers here and all of that. I get it. But we're just talking about the percent of mortgages that are above 6.5. That's 15% of the mortgages in this market are above 6.5%. So you've got that. Also the combination that this is often, South Florida is often a market that turns over quicker than other markets. You get people coming from different parts of the country. Maybe they decide they don't like it, or they decide they want another part of town. All of that is creating a really robust inventory market. Okay. Before I get to the other 10 cities with unlocked mortgages, okay, the other 9 that make up the top 10, I'll get into some more of the analysis. Okay. The metros most likely to see this early movement are the ones above the 6.5%. The homeowners are now incentivized to obviously do that refi or that sell. The research team, though, predicts that mortgage rates will fall to 6.3. So Realtor.com's projection is 6.3 by the end of 24. We've seen some projections that go as low as 6. This expected drop could benefit these identified cities first, but it could also add more to the list. Okay. Implications for home owners as rates continue to ease. These options might become more attractive. Okay. So let's take a look at the 10 cities right now with unlocked mortgages per this Realtor.com study. Again, Naples on top of the list. This is right out of your hot sheet show notes. St. Louis is number 2 on the list. There's a 13.9% of mortgages that are above 6.5%. There's a median list price there of $313,000. The median list price here in Naples is $770,000. Myrtle Beach, 13.4%. Myrtle Beach, another one of those markets. It's a great market to be an agent in. You got people that come from all over to Myrtle Beach to retire, think about buying a second home. There's a lot of movement in that market. Now this is creating, more movement in the Myrtle Beach, this unlocking of mortgage rates. Cape Coral, just north of here, 12.4% above 6.5 on the mortgage. 450 on the median list price. Miami, just under 2 hours across the state. Drive east down Alligator Alley from where I am, you get to Miami. 11.7% on the mortgages above 6.5%. Median list price there, 535,000. Albuquerque, New Mexico is 11.6 of mortgages above 6.5. Kansas City, 11%. Fort Wayne, 10.5. Oklahoma, OKC. Where's our OKC agents out? That's at 10.4%. New Haven, interestingly, at 10.3%. We've seen the Northeast really low. New Haven been one of those, top 10 on appreciation, home price appreciation. You've seen more sellers come to market with that appreciation, and you're getting buyers that are like, buying the last couple of years there as that appreciation continues to tick up. 424 on New Haven, inventory being very low. So the demand still feels high in a market like that. All right. So there's your 10 cities with unlocked mortgages. As the rate continues to move down, you will see an opportunity here in other locations. If I'm in one of those 10 locations, I'm using something like a prop stream to take advantage of those opportunities and have conversations with those homeowners. If they want to capitalize on what could be a record price, some of those areas are in record price categories right now. The time might not be any better than right now. CoreLogic just released their report for August 2024, revealing their price insights. U.S. home prices increased 4.7% year over year in June, according to CoreLogic's August report. Okay. The growth pace is slowing. Okay. So 4.7% year over year, good, strong number in any market. Go back in history. That's going to be a good number. But the pace of the appreciation is slowing. We've seen this for a number of months now. The 4.7 year over year from June 23 to June 24 is a good, strong number. And a month over month basis, it grew by 0.3% in June 24 compared to May 24. Okay. The CoreLogic HPI projects a 0.3% month over month increase from June to July. When we get to that number, year over year growth, though, is expected to slow to 2.3% looking forward 12 months. So their projection when we get to June 2025 is going to be that this number looks like 2.3 versus 4.7. So month over month, as we move forward, the projections are, hey, we're going to continue to see a deceleration of home price appreciation. The impact of mortgage rates obviously is significant. The affordability where home prices and rates are is the significant constraint here. Here are the locations according to CoreLogic with the highest year-over-year price increases. You've got South Dakota at 10%, New Jersey at 9.3%, Rhode Island at 9.2%, Connecticut at 8.5%, New Hampshire at 8.2%. So again, Northeast dominating that list, as we've seen in almost every report here across the country. Okay. Here's your forecast that I mentioned. These charts all available for you inside of BAMX. BAMX members get access to those hot sheet show notes, as well as these charts each and every single day. Use code HOT to get into BAMX and get your discount there. So month over month, 0.3 and 4.7 on the year over year. Forecasting out those numbers, month over month remains the same, but the year over year scheduled to be much smaller. Here's your national home prices by state where they've been the most significant. You're still seeing an increase year over year percent in Florida, but that is starting to decelerate. Remember, that was in the more of the extreme category there for a number of years. You're seeing those more extreme price jumps predominantly in the Northeast and the Midwest. Texas now going under, as well as Louisiana. You're starting to see some softening out west as well on home price appreciation. Again, those top five, as mentioned before, South Dakota, Jersey, Rhode Island, Connecticut, and New Hampshire on home price growth. 4 out of the 5 are in the Northeast. Here are the top 10 metros and how they've changed since we last looked. Miami still up big. Miami's up 10% on home price appreciation. Boston's up 5%, Washington 5.6, Chicago 7.2. This is year over year numbers. Houston 1.7, Phoenix at 4.6, San Diego 7.5, LA 4.5, Vegas 7.5, Denver 1.9. Here are the big risk markets according to CoreLogic of home price declines. Okay. Florida, again, dominating the list with 3 of 5. You got Palm Bay, Gainesville, and Sarasota, Bradenton all on the list. Joining those 3 Florida locations would be Atlanta and Spokane, Washington, all with a confidence score of 50 to 75 from CoreLogic. Very high, above 70% probability of a price decline here, according to CoreLogic. All right, there is your update from CoreLogic. What's happened in the rearview mirror and some of the projections looking forward. Zillow Home value report just came out. They have their home value analysis as well as their sales forecast here. So a little bit of looking backwards as well as looking forward. Zillow now expects that home values will climb 1.8% in 2024. So this is according to the Zillow research team. This number has come down from original projections. This modest decrease from last month's projection of 2%. Last month was 2%, but if you look backwards, they had this a little bit higher in the past. Remember, Zillow last year had original 6%, then they went down to 0%, then they went back up to 6%. It ended up coming in closer to the 6%, but they kind of they'll swing a little bit here as they get data information. What I do like about looking at Zillow's numbers is because of their swings, they're taking in a lot of data in real time. They're reflective of what's happening oftentimes in the moment, where you get, Case Shiller, the gold standard, it's 2-3 months old. So it's hard to miss on those numbers. Of course, if you look in a rearview mirror 3 months back all the time, you're going to be fairly accurate. Okay. Zillow anticipates 4.1 million home sales for 24. That's in line, obviously, with what we're seeing right now with NAR and other reports. That'd be about 1% more than last year, but lower than the previous forecast of 4.2 million home sales. So missing there. For this year, they've remained lower in the flow of homes coming to the market. July was 25% higher to a year ago. And so there you go. Here's their home forecast here moving forward. July 2025, 366,000, year over year of 0.9%. And month over month of 0.1%. So Zillow coming in below CoreLogic, remember, over 2.5% there, as we just mentioned, on their price forecast moving forward over the next 12 months. Zillow much lower. They have a year over year of just 0.9% home price growth. As they look forward for the next month, they see it as 0.1% versus CoreLogic's 0.3%. So Zillow taking a little bit more of the bearish look on home price appreciation in comparison to CoreLogic. Okay. So there you go on Zillow's report. I'll see if there's anything else here of relevance that I forgot to mention. I do want to mention this. Here are their highest forecasted 12-month home price growth. So here's the metros that they're forecasting will grow the most over the next 5 months. They have Knoxville, Tennessee, New Haven, Syracuse, McAllen, Texas, and Hartford. Now, New Haven, we just saw with CoreLogic, has gone up double digits year over year, about 10% or whatever. Now, Zillow's saying, hey, the next 12, you're going to be one of the top 5, but you're going to be coming in at about 3%. Here's the low forecast. Zillow's projecting New Orleans going down 6% over the next 12 months. San Francisco, they've got moving downward at 3.6%. And San Francisco's been seeing, home price growth here over the last 12, 18 months. Baton Rouge, Louisiana, now 3% down, calling for the next 12 months. Austin, Texas at 2.7%, and Honolulu going down 2.5%. So there's Zillow's markets where they have the lowest forecast projection. That would be from July to July of next year. Okay. There's your Zillow report. We'll continue to take a look at that as we move forward. Mortgage Bankers Association this week today, in fact, reports their latest update on mortgage applications. So while mortgage rates have fallen for the third consecutive week, that's on that weekly number there. Obviously, 2 weeks ago, you could have gotten in at a 6.3. Now we're at about a 6.5. That was like a day in time. Looking at the total average week here, refinances dropped 15% despite that. So we saw a boom, a little pop on refinances in comparison to the rest of the year, in comparison certainly to year over year numbers. But that number has now dropped. Also, home purchase applications, this is the one we look at, has also declined 5%, as buyers are now remaining cautious despite these slightly lower applications. Now, here's a reason that's not surprising to me. One, it is because you're going to have a seasonal drop off right now. Okay, I've said the seasonal drop off could certainly get pushed back if the rates get lower. I mean, we get to 6% rates. If this jobs number that I'm going to talk about really impacts the 10-year and the 30-year, that's going to come out today from the Bureau of Labor Statistics, then you might see that seasonal, drop off on mortgage application on demand get pushed out. But at 6.5, it's just not enough to move the needle. And that's kind of what we're seeing here. Here's the headline from CNBC. After the mini boom the last couple of weeks, the weekly mortgage refinance demand falls back 15%. And the applications for the purchase a home fell 5% for the week. That's 8% lower than the same week a year ago. A silver lining there on the 8% is we've seen numbers this year commonly at 12, 13% lower than year over year. So 8%, the gap's starting to get a little bit tighter there, but still we're not seeing mortgage applications move up in any significant way. In fact, obviously, those applications are moving down. Joel Kahn, MBA economist, says that both rates and applications have now stabilized after a few weeks of financial market volatility, which led to quick drop in mortgage rates. The other point to note is that, yes, rates are lower, but they're still 6.5. And so that's what I just said. They're still 6.5. This isn't enough to move the needle, which is not low for those borrowers that were out there with sub 5 rates. Outside of those top 10 markets that Realtor.com pointed out, where you might see some more movement, most of the country is dealing with, a significant population being sub 5% rates, and it's really hard to get them to move off of that. Matthew Graham, Chief Operating Officer at Mortgage News Daily. The lowest rates in over 2 weeks might seem like it's worth more enthusiasm, but we didn't learn anything about the current trends that we didn't know yesterday. Simply put, there's a ton of rate volatility earlier in the month. Been a slow, largely sideways grind since then, and wait for more compelling motivations. Okay, so one of those compelling motivations here that could have a real impact on mortgage rates would be this jobs report. Okay. Before I get to that, I'll just mention this Nick Timiraos tweet. I retweeted it because he usually talks Fed stuff. He's like the Adam Schefter of the Fed. And in his analysis, he's Wall Street Journal. Rates are at levels last seen in May 2023. That's true, right? The rates are the lowest level we've seen all year and really in over a year. But purchase applications are 20% below where they were then. Not sure where he's getting 20%. Obviously, Mortgage Banker Association just came out this week at 8%. So I just think he might be a little bit off there. But again, you're just, no matter which way you slice it, you're not getting the demand that we've seen the last couple of years. And we're really not going to see it until we see these rates move in a significant way. Right now, it looks like we're about 6 minutes. If Bobby, if you could find out from, I think we're going to get that right at 10 a.m. If you can confirm that with Vanessa, she's been tracking that. If we're going to get that at 10 a.m., maybe I'll stay on through that. Right now, I'm not seeing a significant move on the 10-year. I mean, it is moving down right now. We're at 3.803. If there's a really strong belief that this, job number is going to have a real impact, I would have expected this maybe to be moving down a little bit more ahead of release. There's some numbers that are all over the place. Okay, so if you remember on the Zero Hedge tweet that I mentioned on Monday, and I spoke about it yesterday as well, there's a belief, and they were the first really to have this. Okay, there's a belief that, and I didn't retweet that, but Chamath retweeted it, which is why I thought it was interesting. Let me go back to that original tweet. Again, Zero Hedge had it first, and lots of tweets here, Chamath. Where is it? Okay, here it is. So here's the tweet from Chamath. Tell me you're in a recession without telling me you're in a recession. On Wednesday, Bureau of Labor Statistics will downward revise jobs for the April 23 to March 24 period by up to 1 million. This means that all beats recorded in the past year will have been misses, and the U.S. job market is in far worse shape than the administration would admit. Okay, so that was it was interesting to me because of the retweet, the validation almost coming from a player like Chamath Palihapitiya. Now I'm seeing reports all over the place, and it sounds like we're going to find out here in literally 4 minutes. Okay, but you've got Bloomberg out in front of this last night saying the Fed confronts up to 1 million U.S. jobs vanishing in revision. So Bloomberg, big source, talking about this potential 1 million U.S. jobs vanishing, meaning, hey, we were given numbers over the last year that said we're gaining this many jobs, strong job market, very strong economy. Right? There are some people that believe the Fed won't cut, even though CME Group has it at 100% still this morning, and that 0.5% has ticked up today. Might be a signal here on this job report. But there's a lot of folks that believe we're in a very strong economy. There's a lot of folks that believe that we're not, right? Like the Chamath, tell me we're in a recession without telling me we're in a recession. So this, if this were to be true, this really changed the game on strong job market. It's one of the reasons why I kept saying over the last year, like, it feels like an economy that's not working for a lot of people. We kept getting these reports. Okay, the stock market is doing well. The job market is strong. Unemployment is low. Now we're at 4.3%. So that number's starting to get weaker. And you talk to people, everyday people, just the economy didn't feel like it was working for many people, for many folks. New York Post has the same story now here today. Wall Street banks brace for downward revision up to 1 million fewer jobs, fueling worries the Fed failed to slash rates on time. That again from that one there is from New York Post. You've got Market Watch on the same headline. U.S. job gains have likely been exaggerated. Now we'll find out by how much. Okay, so where are these projections coming in? U.S. created a stunning 2.9 million jobs, or 242,000 a month, from the spring of 2023 to the spring of 2024, when the economy was thought to be slowing down, or did it? That answer is going to be revealed here, I guess, in just a minute. So I'm going to get ready for that. If I think I have the right link here, according to Vanessa. I hope I do have the right link. If here's going to be the link. So we'll refresh this. I'll go back to this Market Watch here for a moment, and then we'll refresh that and see if we get that number here in real time. Bobby, can you confirm that we're going to get that number at 10 a.m. from Vanessa and make sure I'm on the right link? The answer
we are going to get those numbers.
All right, perfect. Thank you, Bobby. There's a little cameo from Bobby. Bobby Edits over there here at BAM. Simply put, the revisions try to paint more accurate pictures. So Wall Street predicts a big markdown in these employment gains. Estimates range from 600 to as high as 1 million. So assuming Wall Street is right, it would tell us that the labor market is not as strong as it looks. It's cooled off considerably faster than previously believed. The revisions are large enough, meaning closer to that 1 million number. Economists say it could spur the Federal Reserve to make a bigger cut in interest rates in September than Wall Street now expects, or it could lead to a speedier reduction in the rates months ahead. Okay. And I also said this yesterday. This will change what Jerome Powell talks about on Friday. This number that we're going to get here any second, if it's closer to the 1 million, this is going to change what Jay Powell says on Monday. Economists are cautioning the government's benchmark revisions are complicated, not always easily predictable. In some years, in fact, revisions show the opposite of what economists expect. When we're getting all these frontline numbers this year, it is a little odd. Not a conspiracy theorist, okay? But it's a little odd. We're in an election year, and all these numbers are great. And you look back on the 6 months, and everything is being revised.
Updated numbers are in our chat, Byron.
All right, good. If they're in where are they? They're in my are they in my
StreamYard, in the StreamYard.
All right, in StreamYard chat. Okay. I'm gonna go to these numbers here. I don't know what you're talking about. I don't see anything. Oh wait, I see it. No, I don't. I don't have anything in the chat. So, anyways, I'm gonna go to this original link that I had, and I'll share that. Bobby, if you have a link, this is not showing it to me. If you have a link, then just share it on the screen. Okay. If you're saying it's in the chat, I'm seeing nothing in the chat. So if you've got a link, go ahead and, oh, I'm seeing it. Okay, here we go. Hold on. Let me get to that. Okay, here are the numbers. We've got this. Bobby, if you could actually share this, though, it'll be easier for you because don't have I'd prefer that if they want to throw that into my spreadsheet, I could get to it from there. Bobby's going to share it. All right, there we go. Let's zoom in on this and take a look here in real time. From March 23 to March 24, employment increase in 300, the largest. March 24, national employment increased 1.53, measured by quarterly. Percent employment. So you're seeing these are the markets that were up, Monterey and those other markets there. Let's take another look here. Let's go down, Bobby. Let's see what else we got. Uh, 369 large counties employment first quarter. Let's see. Can we get a headline number here? Are we getting any headline numbers? Let's take a look. Okay, so we're gonna have to pick through this data. Let me go here and just try one more thing. See if we can get this real time number. We're not going to be able to pick through all of this in real time, obviously. I want the number. Did it come in high or low? We're just the estimate is still that it's going to come in low. It doesn't give us a top line number here, does it? All right. Well, we'll take a look at this, and we'll definitely have the update here tomorrow morning. It does show a lot of these gained the replacement of. Okay. We're not going to get there here on this. My apologies on that. I'm not seeing that anybody's got the actual headline number here. Again, keep in mind, if this number has come in closer to that, million job loss at some point today, we'll see, or not loss, but miss. At some point today, we should see a 10-year that starts moving down. It's actually moved up a tick since that report, still just over 3.8. So we saw it. Look at this. on this release at 10 a.m., look at the 10-year bounce straight up and now has come back down. So there's a market right now, as we just tried to do in real time, that is digesting this report. As this report is being digested, there's just like some uncertainty, as you just saw with the 10-year. Again, if once this report is fully digesting, okay, so X is saying some numbers are late. We'll see. Let's see. As the market digests this, we will obviously take a look at this. We'll post this obviously later. I'm seeing now the 10-year is starting to move down now under 3.8. So 3.792, 3.797. So we're starting to see movement down on the 10-year. If we get a significant downward move on the 10-year, we know what that'll mean for the 30-year. 30-year did come in below 6.5 yesterday at 6.49. But this is what we'll be watching here over the next hour, and I'll cover it in full detail tomorrow morning. Obviously, as we're able to digest it here on our end, as the market's able to digest it, we'll get a better understanding. Was it close to 1 million? Was it close to 600,000? There was some reports I saw that were as low as 300,000. 300,000 would not be obviously as significant as a million. Okay. 1 million miss would be significant and suggest a real weakening economy. The CME group has moved this morning back to 34% now on a 0.5 point cut. Still 100% chance of an easing, but 65%, that got as high as up over 80% here recently, that it would only be a 0.25 point. It's now down to 65. So it's moving a little bit back towards, a third of a chance of being a 0.5 point. That movement was as early as this morning. So that's interesting here as the market digests this. We'll see what happens. We'll report back, obviously, here on the hot sheet. BAMX members, reminder, we have a live office hours today. I'll personally be hosting that 3 p.m. Eastern, 12 o'clock Pacific time. You can still get into BAMX by using code HOT. Also, Bobby, down below, you can link up my new agent program resource that I put together, absolutely free gift to you. You can link that new agent program up. If if you're watching the replay, it'll be up in the replay as well. So Angel, thank you for being a part of this. Please subscribe to the channel if you got value. I will see you guys back here tomorrow morning. I'll have a full breakdown. I'm still not seeing, I think what Dawn said is right. Some of these numbers are coming in late. Market is taking some time here to digest it, or doesn't have the numbers at all. And that's why there was some confusion there. I think that's why we saw this 10-year pop up on release and then come right back down. It appeared, it's like when you're looking at that first report, it's like, hey, did the numbers really, was it really a miss? You see that big spike right at 10 a.m. as that data was released, and then back down to really where it started the day. So we'll absorb those numbers, take it all into account, and then we'll be back with you. Until next time, of course, toodaloo.